All right, let me restate that over. This afternoon Saturday session is for educational purposes only. Nothing stated in this session should be seen as investment advice. If you seek investment advice, you should contact a financial advisor or a fiduciary or your CPA or tax advisor. With that being said, I was going to get into it, and I'm gonna turn it over to Kristle. If you want to give a brief introduction about yourself and let the people know who you are.
Thanks, Sean. Hi, everybody. I'm Kristle Henry. I have a PowerPoint to share with you guys. We're going to be talking about the IRA accounts, some different strategies around managing those accounts, and just some other tax topics as it relates to trading. Give me 1 second so I can share. All right. Hold on a sec. Can you guys see that?
Yep.
Okay. I don't know why it's not taking up the whole screen, but all right. So who am I and why are we here today? So essentially, I made a post in the Come Up Cousins group related to how I was personally managing rolling over my 401k from my old job. And in that post, I talked about kind of the implications of the rollover, especially as it relates to being able to do the backdoor Roth, which I've been doing for the last couple of years. And just some other tax implications of doing the rollover. And so that kind of spawned this discussion today. Just a little bit of other background on me. I know I've kind of got introduced to some of you on a Zoom a couple of weeks ago. Investing and kind of the starting capital amounts of investing. So for anyone kind of curious on how that came to be for me and where I was starting with my investing and trading journey, I would just say that over the last couple years, I really focused on that whole 70-30 principle. I'm self-proclaimed budget bandit, and definitely can share, things specifically on that in the future. But really what spawned that was in 2015, I took the opportunity to just go travel for a year. And so I kind of got that taste of being free and not having to, report to a job every day. And I wanted to figure out how I could do that, indefinitely. And so I really just pivoted then and really got intentional and was focused on trying to save and build wealth. And then I am a CPA. I put a little asterisk next to it because I think when people hear that someone's a CPA, they automatically go to, can you do my taxes? And I just want to say in general that I know a lot of smart people who are CPAs and they do great things and they're subject matter experts in what they do. And I wouldn't let them do my individual tax return. And I say that to say it gets really specialized in the world of accounting and tax. And so my background is actually in corporate income tax. But of course, I know more than the average person as it relates to, the tax sheltered accounts and even on the individual side trying to optimize. But if there's something that someone wants to know and ask and I don't know it off the top of my head, I will humbly let you know that. And I'll take a note of it and research it for you and get back to you. So if everyone's cool with that, we can get started. All right, and again, gonna focus on the IRA accounts. I heard that some people had questions about capital gains, and then also the trader tax status. And then I just wanted to talk in general about kind of being efficient with investing from a tax perspective. There's kind of his historical way to do that, and then starting to think about and have a discussion about what it looks like if you're mostly trading options, which, up until recently, I was kind of taking the traditional method, and now I've incorporated options into that, and how I've started thinking about how to be efficient with that. All right. So most of you will probably know this. I just wanted to give like a quick rundown of the traditional versus the Roth IRA, and just highlighting things that I think are kind of the most important. So I know kind of in the community, we say, put everything in a Roth if you can, get it in there. Of course, the main thing with that is that you will not pay taxes when you take that money out. Conversely, with the traditional, you're paying the money, you're getting the deduction at the beginning as you're putting the money in there, and then you're gonna have to owe taxes when you're taking the money out. The thing about the Roth, so anyone who has earned income can contribute. Earned income like your W-2 income from a business. However, for your Roth, you're limited to being able to contribute to it if you have modified adjusted gross income of these limitations for single, married, and then married filing separately. So if you are single and you have income over 140K, you no longer can directly contribute to a Roth IRA. And so we'll get into, with the backdoor Roth, how you can get around that. But at face value, once you hit those income limits, you get no deduction. There is a phase out period with these amounts. So for example, with single individuals, it starts at 125K. So under 125K, you would get the full ability to put the full 6K or 7K in, and then it starts phasing out up to 140 where you get zero beyond that. So that's how that works. And then everyone knows you get the 6 or 7K depending on what age you are. With the traditional IRA, you can always contribute to it, but the distinction is whether or not you're going to get a deduction or not. So if income above these levels, single, married, married, can't take a deduction limits. So you can still put the money in there, thing to note, but benefit putting that 6K under the traditional IRA. And then one thing I think that sometimes people miss is that you technically get 15 months to get the money into the account for any given tax year. So for this year, for 2020, if you haven't gotten the whole 6K in either account total across both accounts, so 6 across all of your IRA accounts, that's important to note. You have still until the tax return due date of 4/15 to get the money in against 2020. And then at that point, anything you contribute would go towards the 2021 tax year. I just mentioned this at the beginning. So when you pull the money out of the traditional, you're going to get taxed as your ordinary tax rates. Conversely, with the Roth, is tax-free. One thing with the Roth that sometimes people know and sometimes they don't is that the contributions can be taken out anytime without penalty. So that 6K that you're putting in every year, when you take withdrawals, those that's the first thing that comes out. So it goes against your contributions first. The only caveat to that is conversions, which I'll get to when we start talking about the backdoor Roth IRA. And then you can start your withdrawals at age 59 and a half. So prior to that, you're going to get hit with penalties if you take out before that age. After that age, you can start taking out from both accounts without penalty. And then this is another thing that, this is another thing that I think people don't know about the traditional IRA. At the age of 70 and a half, you have to start taking out. There's this required minimum distributions. They calculate it based off of your life expectancy and how much money you actually have in the accounts. And at that age, you then have to start taking the money out because the IRS wants to start taxing you on that. Conversely, with the Roth, you do not have that. So, you know, if you're building up your wealth in a Roth, that's another benefit that, you know, if you plan correctly, you may never have to touch the money in your Roth IRA in your lifetime, and you don't have to take any of it out. So it can pass on to your heirs without you having to take any of it out, be required to take any of it out. So that's also a neat feature of the Roth. And then for the penalties, you know, you do have the 10% penalty when you take out early in the traditional IRA. And of course, you have to pay the taxes on that money as well because it wasn't taxed before. And with the Roth IRA, you get a penalty and you have to pay tax on the earnings if you take out any earnings before you're 59 and a half and you haven't had the account for more than 5 years. If you've had the account for more than 5 years, then you would just have the penalty for withdrawing early. So, you know, you do not get that tax savings on the earnings if you pull it out early and you haven't had it for 5 years. So that's a good thing to note about the Roth IRA as well. Let me just pause and see, does anyone have any questions? I can't see the chat. I don't know if anyone's putting anything in chat, but does anyone have any questions on this so far?
Are you asking?
I'm sorry if you've already answered this question. I do have a question though. So say you you can withdraw at 59 and a half. Can you still put in at 59 after you're 59?
Yes, you can put into either account as long as you have earned income. So let's say you haven't retired yet and you are still working, as long as you have that income, the 6K to the account.
Okay, thank you.
Kristle, I have a question.
Sure.
Is someone able to open up a Roth IRA under their business name? Is that possible?
You can open up, you can open up a 401k under your business, and you can do the SEP IRA. It's there's a couple different rules with it, but you can do both pre-tax and Roth contributions up to the limits that you have with both of those.
Okay, thank you.
Mm-hmm. Okay. All right, so just a few other things. So I mentioned the 5-year period for owning your whole Roth IRA account. There's kind of another 5-year stipulation that comes into play, and it involves when you're converting. So we're about to talk about the Backdoor Roth IRA. And in that strategy, you're converting IRA to Roth IRA. So when you convert, there's a 5-year lockup period, so to speak, every time you do a conversion. So if I took a piece of my IRA and I converted it to a Roth IRA, that amount would not be considered a contribution until after 5 years. So, you know, I mentioned earlier that your contributions are you're able to take them out without penalty at any time. So this kind of just locks up that conversion. It doesn't make it a qualified contribution until after 5 years. So I think that's important to note, because I think people just think, oh, if I'm putting the money in, but that's not considered, your normal contribution until after 5 years. And then if you can't deduct your contribution to an IRA, so you're over those limits that we discussed earlier, you can still put money in it. So, and it's just called a non-deductible contribution. So when you do that, you do have to do another form in your tax return, Form 8606, and it basically just keeps track of any non-deductible contributions you make to your IRA. And you're going to want to keep track because you don't get re-taxed on that money. So if I can't contribute to an IRA, but I want to put the money in an IRA, and for whatever reason I'm not putting it in a Roth, I can do that, and I can keep track of that $6K or whatever the amount is, and I won't have to repay tax on that when it comes out later. All right, and I think I getting some chat. Which one is better? So I think this depends a little bit. So honestly, if you're making contributions to your 401k and you're doing that pre-tax, I would personally prioritize the Roth at that point, because you're getting some pre-tax, you're likely getting a match on that. And you are getting some pre-tax dollars set aside, and you're getting some tax savings for that already. And in that case, I would prioritize, funding the Roth. It's a big driver of that kind of which one's better discussion is, what's happening with taxes. Do you think you're going to owe more taxes today versus later, when you don't have as much income coming in? The one thing I'll say about that is, how much taxes you're going to owe today. You're not going to know what it's going to be in the future. You can kind of guess if it's going to be higher or lower. But one thing you kind of can control with the future is that when you are, taking money out of your IRA, before the required minimum distributions happen at age 70.5, you have some control over how much you take out. So you could be strategic about how much you take out, such that, you're not paying as much taxes on it as you would be during, your highest working year, the compensation for your highest, year. So there's some tax planning in that, and being strategic about, how you fill up the accounts. And I'm going to go over just a little bit later, kind of, the rule of thumb that I followed up till now, and about filling the accounts. That's later on, but that's something to consider when you're thinking about which one to go with. But if you're already doing pre-tax with your 401k, or you're doing Roth with your 401k, maybe you do the other in your IRA. And then, I think I've seen in the group a couple of times, and then, Cornelius posed the question, what happens if you over contribute to your Roth? So it is, a set max 6K or 7K. It is not a per account maximum, it's a per person maximum. And so you could get in a situation, and even with record keeping, especially if you're doing both, maybe you're doing 3K to a Roth, 3K to the traditional, it's not hard to over contribute. So you have a couple options if you do that. If you figured out you over contributed for 2020, for instance, but you figured it out now, you can go ahead and take the money out. If there were earnings on it, you would have to owe tax on the earnings, and potentially the 10% penalty, but you would avoid an excise tax that they institute, basically a penalty of 6%. And that penalty comes into play for every year that you have those extra contributions in the account. If you don't figure out that you did excess until after you filed your return, but it's 6 months but it's before 6 months after the tax return due date. So you basically have until October. You can amend your tax return and do the same thing as above, which is take the money out and you'd owe tax on the earnings. Then past October, you could actually just consider the extra contribution as a carry forward for 2021, but you would owe the 6% penalty on those excess funds just for this year. You wouldn't keep owing it in subsequent years because now you've said that this excess is counting towards 2021. But if you do that, just make sure you don't go over again because, you know, you basically already filled up, you know, part of your maximum for 2021. Let me stop there and see if anyone has any questions.
Yeah, there's about 3 questions in the chat. Do you want me to read them to you, or did you find the chat?
I don't know if I can see the chat.
I can read them. The first question is, what are the benefits of trading in a traditional IRA account?
I will get there a little bit later.
Okay. Next question. In the context of the come up rolling forward strategy, a person with a brand new Roth IRA will have to keep profits in the account for 5 years or else be hit with the 10% and the tax penalty.
Yeah, so I'm kind of touching on that later, but I guess the question is, you know, what should you do? Because your money's basically tied up for 5 years. Is that really the root of the question?
Yeah, that's what it sounds like.
Okay, yeah, I hit on that later too.
Okay. And you just touched on this last one about contributions. Okay.
Okay. And this last bullet is not about IRAs, but just in case, you know, someone wants to know about specifically for this year with COVID happening and the CARES Act, if you took out a withdrawal from your 401k, they allow people to take out up to 100K. If you had to do that, the way that it works is you can either claim that 100K as income for the 2020 tax year, or you can spread the amounts out over the next 3 years. There's some level of strategy with that as well. Like if you took it out because you were unemployed, you may not have as much income, and it may make sense to, you know, take the whole thing this year, so it gets taxed at lower rates. There's also some strategy involved if you plan on paying it back. So they stipulate that you could actually pay back what you took out in 3 years, and then you basically do amended returns to get any tax you paid back. So if you think you're going to pay it back, then it may make sense to just go ahead and do the 3 years, pay as little tax as possible this year and next year on that, because it could push you in a higher tax bracket, and then pay it back and get all the tax back that you paid, and you wouldn't be paying it all this year. So just in case anyone did take advantage of that, those are kind of the main stipulations of it.
Okay. Follow up for the CARES withdrawal. Can you wait until year 3 to claim it all as income?
No, you either have to do it all this year or you can spread it out over 3 years. So you can't hold it until the 3rd year. So those are your 2 choices. So again, it's if you're planning to pay it back, then you may want to do the 3 year so that you're paying less tax this year. You're going to get the tax back. So you amend your return, any tax you paid, you would get back. So if you claimed it all this year, you're paying you're paying tax on a way higher amount, the whole 100% that you took out versus 33.3% over 3 years. So if you don't plan on paying it back, then you could be strategic and do it all this year because maybe you didn't have income and you're going to be maybe in lower tax brackets with the amount that you took out, or depending on what you're expecting your income to be, you know, it still may make sense to put it over the 3 year period. So the backdoor. So let's say you're over the income limits. So as a single person, your adjusted gross income is over 140. You would get no contribution to a Roth. However, this is, a legal method, like the IRS knows that people do this. This is a legal method to essentially still get the money into your Roth IRA using this backdoor Roth method. Now, it's not a separate account. It's just using an IRA that you have and a Roth IRA that you have to make this conversion. So you do need an IRA account, and you do need, of course, your Roth IRA that you want to put the money in. And what you would do is you'd contribute the cash to your IRA as a non-deductible contribution, a non-deductible contribution, because as I said before, even if you don't take the deduction, you can always put money into your traditional IRA. And then you take that amount and you convert it into a Roth, because you're able to convert, any amounts from your traditional IRAs to your Roth IRAs. Typically, you want to do it literally the very next day. So when I was employing this strategy, I would, on January 1st, contribute the 6K. You don't have to do all of it at one time if you don't have it all right now. But if you have it, you might as well just do the whole thing at once. Put the 6K in the traditional IRA. And then the next day I would execute the conversion from the traditional to the Roth. So I was doing this in Vanguard. The main brokerages are going to have a pretty easy way to do this. I went into my IRA account and they had an option there that said convert to a Roth. And then I clicked that and I just followed the steps. It will ask you if you want to have withholdings taken out. The answer is no, because you already paid tax on the amount that you are converting. You're not getting a tax deduction for it. So it is after-tax money, so you do not have to do any tax withholding on it. And so it's really very simple. And so you still get the benefit of getting your money in the Roth, even though you're above the income limits. And this really comes in handy if you are already contributing to your 401k pre-tax. You really do want to have some funds in your Roth and have that kind of diversity of your accounts. This is a way to still get it done where you otherwise wouldn't be able to. Okay, so that process is very, very simple if you do not have any other IRA balances. So it gets really, not tricky is not the right word, but I think when I did the post, I said messy, because it starts to, there's a lot of tracking that you have to do if you still do this and you have IRA balances. So if you have no IRA balances, seamless, easy. You do have to do the Form 8606, but it's simple. If you have IRA balances, though, the IRS looks across all of your IRAs, both traditional and Roth, and they say any conversion that you do is a representative sample of all of your accounts. So I put an example here to kind of illustrate the point, because let's say that you have a 60K IRA balance because maybe you had a 401k and you rolled it over into an IRA from an employer, which is the situation I was in when I made the post I made. The IRS looks and says, okay, you have this 60K IRA balance. You contributed 6K to it. That's non-deductible. You want to convert that 6K. We're going to consider that conversion includes both pre-tax and after-tax amounts in their relative share. So what you would do in this case is you have $6K that's non-deductible. You divide that by all of your IRA balances. And in this example, that's 10%. And then the amount that you are rolling over or converting into the Roth, only 10% of that would be tax-free. They would consider that you actually converted $5,400 of the $60K IRA balance as well, and only $600K that was non-deductible. And then you'd have to keep track that you still have $5,400 of non-deductible IRA balances. So it definitely gets more complicated if you have IRA balances, because they basically are saying part of this money is taxable. And again, you have to document all of this on Form 8606 if you do this anyway with IRA balances. So for me personally, and what I said in the post is, because of the next topic we're going to talk about, I'm not going to worry about doing this now that I have IRA balances. I didn't previously have IRA balances, which is why I have been doing this backdoor Roth for the last 2 years. But now that I've left a job and started a new job, I had a 401k that I didn't want to leave because I wanted to be able to trade out of it. So it's beneficial to me to have the IRA balance there. But now the backdoor just gets a little bit more messy. And again, like all of these amounts are going to be different every year. Not saying not to do it. It's just for me, I decided not to do it because I had other ways of getting money into the Roth. So let me stop there and see if there's any questions specifically on the backdoor Roth. I can't see. It doesn't look like there's any in the chat, but if anyone wants to chime in.
Yeah, I don't see any in the chat right now.
Okay.
I'm sorry. I do have a question.
Sure.
So basically what you're saying, I guess my main question would be, are you able to have multiple regular traditional IRAs? Because I have one that I converted from an old job. And then I was under the assumption that I could just put the 6,000 in there and then transfer it over. But what you're saying is that's going to be very difficult to do.
Yeah. So two things on that question. You can have as many IRA accounts as you want. For instance, I'm going to have two. I'm going to have one for my rollover, kind of similar to what you just said. And then I'm going to have one that I'm going to keep my non-deductible contributions in, just to keep it separate. So I know that I don't have to repay tax on any contributions I made to that one. But secondly, to your question, all of the IRA balances that you have will come into play with the pro rata rules. So because you have those IRA balances, the 6K that you convert is going to be subject to this math that I have on the screen. So part of it would be subject to tax because you're basically converting pre-tax into the Roth after tax if you already had those balances. So the rules for this, and which is why I actually didn't roll over my IRA, my 401k into my IRA until yesterday, is the math is based off of whatever your balances are at the end of the year on 12/31. So whatever your balances are for 2020, if you have IRA balances on the last day of the year for that year, then you're going to be subject to these pro rata rules on any amounts that you converted to a Roth. Did that answer your question?
Yes, it did. I just now need to see if I can stop my contribution.
You can still contribute. It's just I don't know, for me, so there's a couple things to consider with this. Like if you really do need,
I mean, I think that because I did the full amount, and what you're saying is that, I mean, I have, more than 60,000. So basically you're saying that it's all going to be taxable again. So I will have to pay tax on it twice.
Well, no, well, so they're not considering it as if you're paying it twice though, because, and this is why. So
I'm
let's say,
because if I've already paid tax on it and then I put it into an account and it's taxed again, that to me, that's being taxed twice.
Yeah, but it's not though. So let me show you why. So in this example, 600 is tax free, right? And 5,400 is taxable. But you still have 5,400. That what that essentially does is leave 5,400 in your non-deductible IRA pile, so to speak. So that money never doesn't get taxed again, but you have to keep track of it. And this is why I personally decided that I wasn't going to mess with this at all, because that's something that you're going to have to keep track of. So, it feels like you're getting taxed again because you contributed after tax dollars wanting to convert them, and then you ended up paying tax on majority of that. But the IRS views it as you're paying tax on pre-tax dollars that you already had in your IRA balances, and you still get to keep the balance that you did not convert, that wasn't tax-free, in that account, and you won't get taxed on it again. You just definitely have to keep track of it. Does that make sense?
Yes, I understand. Thank you.
Mm-hmm. Okay.
I think we have 2 more questions inside the chat.
Sure.
You want me to read them out?
Yeah, I haven't quite figured out how to get to this chat.
Someone asked, is a rollover IRA considered a traditional or Roth, or do I need to choose which to roll over to?
So you choose. So I'm a good example again for this one. So I actually, when I first started working, contributed to my 401k as a Roth 401k, and then later switched it because I wanted more tax savings. And so when I left my job, I had a 401k that had both pre-tax contributions, and then it had Roth contributions. And then for your employer matches, those are considered pre-tax as well. So even if you did Roth 401k the entirety of the time, you would still have some pre-tax amounts because your employer matches are pre-tax. So I had both types in my 401k. And so when I rolled it over, I went ahead and rolled over the Roth earlier in December. And I rolled that Roth portion of my 401k into a Roth IRA. And then actually yesterday, I rolled the rest of it, the pre-tax part, into a regular IRA. So you can keep them in the same character that you contributed when you do the rollovers. So one 401k balance can go to, both types of IRAs. You could actually roll it all over into an IRA, but again, then you have to keep track of what part doesn't need to be taxed again. Or you could convert the whole thing to a Roth and then pay taxes on the portion that was pre-tax and get it all into a Roth. So you do have some flexibility there.
All right, and second one was kind of more of a strategy. So is it better to roll traditional IRA into the backdoor on a year that your income is lower, so that you're in a lower tax bracket?
Yes, that is some strategy, and I was going to go on this a little bit later, but let's say that and let's say that you're not doing this backdoor thing. You're just converting for the sake of converting. Like you want to take IRA into Roth, and it's not beholden because you are over the income limits for Roth contributions. So let's say you were unemployed for most of 2020 because of COVID, and you have large IRA balances. You could have converted portions of it so that you could get taxed at a lower tax bracket because you didn't have the ordinary income pushing you into higher tax brackets. So let's say you were unemployed the entire year, you had zero earned income, and you had, let's just for argument's sake, you had this $60K IRA balance. You could roll over $12K tax-free because you get your standard deduction. Everyone gets that. So $12K you could offset with your standard deduction, and that'd be tax-free. And then you could start converting a little bit more up through the 10% tax bracket and 12% tax bracket. If you went up through the 12% tax bracket, you could convert, 52K with paying at most 12%. So there is some strategy to that. And I mean, this is something, people do as they start to think about retirement and how they're going to live and how they're going to get access to this money, especially if you're trying to retire early, which everyone on this call has that goal. It is something to start thinking about, like, how do you get access to your money?
Okay, there's one more question before you move on. I think I know the answer to this, but needs your input. Is there any way to utilize your employer's IRA for option trading?
You mean your 401k?
Is that what you mean, James? The 401k? I think so.
Okay, yeah. So, unfortunately, most 401ks, have some restrictions around them. They don't want people losing all their money. So if you're, in an actual qualified 401k plan with an employer, you're likely not going to be able to trade options out of it. The best case scenario, from what I've seen, is some companies allow you to do brokerage link, which essentially kind of just opens up your investments to like a wider variety of ETFs, mutual funds, and things. Because typically most employers have like 25 to 30 selections in their plan. It's not very, it's not a lot of selection. But at least with Brokerage Link, you could take your contributions to your 401k and invest it in kind of, your VOOs, some of the other more popular ETFs and such. And so that's kind of the best you can get. But, this is why I wouldn't say leave your job to get access to your retirement. But like I mentioned earlier, I've been at the same employer my entire, career. So, all that money was locked up in my 401k this whole time up until I left in November. And so I'm kind of like a kid in a candy store because I have access to that money now, and then kind of, discovered the come up cousins. And once you get that money into an IRA, you can trade options out of it. So, I would say there's a little bit of being strategic about how much you put in your 401k, how much you put in your IRA. Like if you have, for instance, let's say you wanted to max out your 401k. It's 19,500 is the max you can put in there. But you want to trade. You could be strategic, and depending on what your income is, and if you can deduct for the IRA, you could put 13.5 in there, put 6 in their traditional IRA, and you'd be able to trade options out of it, and you still get all the tax benefit of the 19.5. So that's just off the top of the head, one idea. to be able to get more capital for trading options versus, whatever the investments are in your 401k plan.
Yeah, that answered my question. My bad. I couldn't get it on mute earlier, but I appreciate that.
Oh, no worries.
I have a question. As far as contributing to the 401k, when is it more feasible for you not to contribute? Example, my company matches the first 6%. So I'm doing 20% towards my 401k, 6% of it is going to pre-tax, and the other 14% I have going to Roth.
Okay.
I chose to do it that way because I figured that was the way that I could get more into a Roth account. But with the money that's going to the actual 401k, I don't have a lot of options. They don't let you do a brokerage link account. So I'm stuck with their choices. So I was torn between, should I continue to contribute over the 6% and just get hit with the taxes? Because that's why I was doing the whole 20% because I was trying to save taxes.
Right. Did you, so in your scenario, you would actually only save taxes on the 6% because the 14% is going in after tax. And I would say, are you able to max out your 401k and also contribute to the IRA maxed out?
When you say maxed out, what do you mean?
So you can,
19.5?
yeah.
Well,
So
I guess I could. I hadn't thought about it because I stopped at that 20% so that I would be able to still save some money and throw it in the market and be able to invest in what I want to invest in.
Gotcha. Okay. So I don't see anything wrong at face value with, the way that you did your contributions. I would just say that you can also contribute to the IRAs. And if you're weighting so much in your 401k to the after tax, maybe go ahead and just do your IRA as pre-tax, get that deduction. And then you have, your 6% that's going in your 401k, you have 6K that's going in your IRA pre-tax, and then you have the 14% that's going in your Roth 401k, all of which the 401k at some time in the future, you'd be able to roll out into their respective IRAs.
Right. Okay. So, and I do contribute that extra 6,000.
Yeah.
I know what you're asking. So yeah, I do that as well. I was just trying to see what was the best way to get because I'm single, so the taxes hit you harder. When you're making 6 figures, it's like you try to search for every way.
Honestly, if you're making 6 figures, I personally would do no Roth 401k. That's my personal, yeah.
And what's the benefit of that? That'll be more taxes saving.
That'd be more taxes. Because that'd be more tax savings because and this actually, hold on, I made a little give me 1 second to get out of this. This is a very simple example, but it gets you starting to think about like strategy when doing these accounts. So you get these deductions, and I don't have the 401k deduction on here, but it works the same way. Where deductions, if you think about it in the tax savings and also invest that, you're going to be further ahead because like in this scenario, the person's getting the 6K deduction, their taxable income's lower, their tax liability is lower. Now, most people will go and spend that tax savings, or they won't even be cognizant of how they got the extra money. But in the case where you don't get the deduction, you pay more taxes. And so that's less money that you can actually put to work. So if this person A does decide, okay, I'm going to do the IRA deduction, this is the amount of tax that they're not paying right now by taking that deduction. Don't spend that money, put that money to work, put that money in the market too. you have, in this scenario, $7,200 going into the market if you don't spend the tax savings that you got from taking the deduction. And the same applies for the 401k deduction. I could replace this with the 19.5, and you actually, let me just do it. So in this scenario, you saved $3,900, which you could put in the market and not spend that. So that's just one way to think about how the money is interacting in these accounts, like because as I'm definitely going to talk about later, we want to get as much money in these tax sheltered accounts because the benefit of both, and I don't want to harp too much on one or the other, because you're getting benefit from either one, and the benefit is that you're able to accumulate tax free when you're doing especially as we're trading, and we're maybe you get into a shorter term position, a leverage play, and you can't hold it for a year. You're only holding it, let's say 8 months. If that's in a taxable account, you're paying short-term gains on that. Mm-hmm. But if it's in your tax sheltered account, you can keep accumulating. You can keep, trading and avoiding taxes on that if you're in an IRA, and never paying taxes on it if you're in a Roth. So that central piece of it, the accumulation part where you're able to do that tax-free, is the crux of both of these accounts. And that's the biggest benefit to both of them.
Okay. All right. Thank you.
Mm-hmm. All right. I'm going to go with this because then I can see my links. All right. So we did that. Mega Backdoor Roth is kind of the final piece of this whole Roth journey. And for me personally, this is why I'm not going to mess around with the whole backdoor Roth anymore and deal with the whole pro rata calculations, because I have the luck that my employer actually allows us to do after-tax contributions, and this is separate from Roth 401k. But it's after-tax contributions to your 401k. So the max is 19.5 for an individual, and then you have 37.5 that can be a combination of your employer matches and then any after-tax contributions that you do. So for my employer, they limit us to 10% of our base salary. So it doesn't include bonuses and things like that. So I can't get all the way up to this 37.5 in my employer 401k plan. But that is the maximum allowed by the IRS. So if you have this mega backdoor Roth available to you, definitely check with your employer. Definitely check and see if they have in-service rollovers, because that is a way for you to get more money into your Roth. So what happens is you do the after-tax contributions, and basically every year you roll those contributions into a Roth IRA, and you still get the money in there, and that does not go against your contribution. So it doesn't, it can be more than 6K. It's irrespective of the 6K maximum that you already get. So, this is a very powerful thing if your employer has it. Now, all employers don't have it, unfortunately. My previous employer didn't have it. I've noted that a lot of, people in tech, the companies in tech have this. So if you work for a tech company, definitely check that out. But that's not the only people that have it, but I definitely know that it's pretty prevalent in tech companies. So definitely check out if you have this available to you, and then you can start to kind of plan how to put money in all of these accounts collectively with everything that's available to you.
Question.
Mm-hmm.
So if my employer matches up to 6%,
Mm-hmm.
I can put in 6% of my income in the regular 401k.
Mm-hmm.
And then if they do offer in-service rollover, put whatever else I want into that. And then that I can transfer that or roll that over at the end of the year or whatever
Mm-hmm.
to a
So
Roth in addition to my 6,000.
yes.
Ah.
So let's say that you are able to max out your Roth with your individual contribution, so 19.5. And then on that 19.5, you're getting 6%. Let's say that's 5K. Employer match. So, well, it's 6% on your income. So let's say that's about 5K. And that 5K goes against the 37.5. So then with your 19.5, 5K employer match, you would then have 32.5 up to 32.5 left that you could do this with, depending on other rules that your company has. Again, like my company doesn't let us put more than 10% of our base salary in there. Other companies don't have that stipulation, and you literally could throw 32.5K in that after tax and roll it over into a Roth.
So would you advise to do the max of the 401k before you take advantage of this? Or can I just do 6% of my income and I get the 6%, which is in this example, $10,000, and then whatever else I feel like I can put in the after tax contribution? Or would you?
Yeah, I think that it would depend. So if you're able to max, I would max out the pre-tax first.
Okay.
Because then you're just piling it on at that point. You're maxed out pre-tax, you can do this backdoor, you still have the 6K for your IRA contributions. You'd be in really good shape. Now if you aren't maxing it out, there could be some strategy there. If you are able to do the backdoor Roth or even the direct Roth, but if you're maxing out, you're likely probably in a backdoor Roth situation.
Because I'm thinking well, as far as a lot of people can't trade out of their current employer plan. So if they're able to contribute whatever they're able to contribute and match this employer, whatever the employer offers, if they're able to trade out of their Roth, then they have money to play with, more money to play with.
Yeah, exactly. And that's why I said initially, like if you're maxing all these things out, go ahead and max it. If you're not, there could be some strategy in saying, okay, I'm going to put maybe half and half, like half of what I can put in my 401k in a year, I'm going to put half in pre-tax and half in after tax. And so I can get that into a Roth and trade out of it. Because you still, I'm a fan of pre-tax. I know that like the Roth sounds great, but I'm also a fan of pre-tax just because you do get additional tax savings from that too. So you're going to be paying less tax when you put in pre-tax as well. That's more money that you can trade with.
Yeah, that makes sense. Thank you.
Yeah, no worries. And I actually have something that visually shows kind of the thought process of kind of thinking about where you're bucketing this later on. So we can talk about it further. And again, this rollover is tax-free.
Hey, Kristle, before you move on, could you take a few more questions and we'll just hold the rest of them until after you finish?
Sure.
Someone asked, are you going to be speaking about the 403B?
I didn't put it in because I thought we kind of have a jam-packed, but happy, to talk about it on another occasion. It functions basically like a 401k. There's some differences, actually some benefit, that there's additional contributions that you can make, after a set number of service years. It is kind of more restrictive. Like, we've all seen 401k plans if you've ever had a W-2, and how, the choices are kind of limited. Same for 403b. Just some general commentary about it, but hadn't planned to dig into it further than that in this call.
Okay, we'll save that for another time. And someone asked, is it not better to have money accruing tax-free because the returns are much higher during the accumulation phase?
Yeah, that's why I mentioned earlier, I'm definitely a fan of pre-tax accounts. Like, I try to get as much in there, especially if you think about it in this way, where, yes, you're gonna have to pay money on the 6K you put into your IRA, but if you're diligent about investing the tax savings, and you do well with that, the money you made off the tax savings could more than pay for the eventual taxes you have to pay here. But all of this is accumulating faster. Like, you're in this scenario now, since I changed the numbers, you have almost 10K that you have invested if you invest your tax savings versus actually, let me change this back, because let's just make it the Roths. You have 7,200 that you can invest if you're diligent and you actually invest the tax savings that you got. And if you invest this correctly, you can far outpace what you would otherwise owe on this later. Because remember what I said earlier, when you're taking this money out of your IRA, you can be strategic about it. We don't know what the tax rates are going to be. That's definite. But it's not like you have to take that whole pile of money and take it all at the same time and pay, an inordinate amount of tax on it. You can be super strategic about when you take it out and how you take it out, and take advantage of like lower tax rates in years that you're not working, and like take it out, a little bit by a little bit. So, I greater on the, money that you're taking out of the IRA. And so I'm a proponent of the pre-tax. I want to save, but, and, account management scenario, you have some of both.
Okay, then they had another one. Would you recommend changing the withholding, on a W-4, and then contributing additional monies to the employee's tax advantage program and personal Roth IRA?
So you should make your withholding be what you think you're gonna owe. So you should pair it up with what you think you're gonna owe. There's a lot of great tax calculators on the internet. Off the top of my head, I definitely like the calculators at Smart Asset. And what I do when I'm planning out like what I'm putting in all these accounts is I'll go and I'll take my income. There's a calculator where you can take your income, you can take all your deductions, like your medical deductions, everything that's coming out of your account. It lets you show what's coming out pre-tax, what's coming out after tax. And I figure out what my after tax is going to be, but that allows me to also figure out what my tax liability should be based off everything I'm planning to do. So if I'm planning to max out my 401k, if I'm planning to do let's say you have enough, you have a low enough AGI to do the 6K pre-tax in an IRA, like you can play with all of those numbers, figure out what your tax liability is going to be, and then you create your withholding based off of that. So in general, beyond that, I personally double check kind of how I'm doing on my tax pay-in quarterly, because I also do some things with like front loading my 401k. So I'll put in more at the beginning of the year and get less money after tax. And obviously I'll have more tax per paycheck in later once the 401k is maxed out. And so I just keep tabs on kind of what I've paid in. I think this is going to be way more important too with trading, especially if you are in a taxable account and you're doing some trading in there. The goal is that you fill up all of these pre-tax accounts and tax sheltered accounts, and then you have some excess for brokerage. At a certain point, you're going to get to the point where you've exhausted all these accounts and you have to put money into a regular, just taxable account. And you're going to want to kind of keep tabs on, if you're not holding for longer than a year, if you're going to have capital gains and what that looks like. So I always recalibrate that every quarter and make sure that I'm doing enough withholding, because my goal on my tax return is to have a zero, like, or O. Like, I don't want a huge refund, because a huge refund means that the IRS had my money hemmed up and they were making money off my money that I could have been making money off of. So I always recalibrate it, and I try to get it as close to zero as possible. I don't always do that, but if I can get it on either side within 1,000, I think I've done a good job.
Okay. And we're gonna go with this last one, but I'm not sure if I'm pronouncing it right. Garnell written. That question you have, I think, is kind of more personal to your specific, I guess, situation. So maybe if you hold on later on, you can ask her that one. But I'm gonna go to this last one that I asked. Can you create a mega backdoor Roth if you're an independent contractor and have your own LLC? But I would like to add to that one, would it be not beneficial to have an SEP in that case?
So all of these income limits are like wide open if you work for yourself. So not the limits on like what you can contribute for, but so remember I said the 19.5 and then the 37.5, like that same bucket of money is available in any kind of accounts that you have as a business. So let's say you do a solo 401k, you still get the same amount as an employee would get. The cool thing about it, though, actually, just to kind of add on to this, is that if I have a business and I wanted to get more money into my accounts, and I would be able to still fill up to that max that I didn't do with my employer. So there is some flexibility if you have both. Like you can, the maxes are the maxes at a per person level. So you could even have a solo 401k outside of your employer 401k and be able to contribute more that way as well. Cornelius, can I ask a quick question? I don't know how long you guys usually go. I have a couple more things. Just want to, do a time check if you guys are good.
I mean, we're good. I think it's mostly based upon how much time you have to.
Oh, I'm good. I just wanted to make sure that. Okay.
Yeah, you're good.
Okay.
That's why I'm just gonna hold off for the remaining questions until you finish, because you only got like a couple more slides to go up.
Yeah, a few. Okay. All right. So, capital gains. So I think, generally speaking, we've all heard short-term capital gains. If you own the security for less than 365 days, that goes with your ordinary income, just as if you had earned it at a job. So, the top tax rate for that is going to be your 37%. long-term capital gains right now is first is 365 plus 1. So don't fumble the ball at the 5-yard line. Make sure that you're 365 days plus 1 for long-term capital gains. And once you get past that, if you sell, you're taxed at 0, 15, or 20%. And it's marginal, just like your ordinary income tax rates. Two main points on this are if you have net losses for the year, you can deduct a $3K net loss against ordinary income. I actually had this situation last year where I don't know what, I had a financial advisor. I don't know what he was doing. I manage everything now myself, but I had I think my net loss ended up being $4,500. And so I was able to take $3K against my regular W-2 income. And then I was able to carry forward the remaining $1,500 and put that towards year 2020, which the gains, I had some gains in 2020, so I can use that loss this year against those gains. There are ordering rules to this. So the IRS is smart. You can't immediately take, short-term losses and put them against long-term gains before you order them together. So short-term versus short-term is first. So short-term losses will go against short-term gains and wipe those out. And then you have whatever your net position is with short-term. Then you have long-term losses against long-term gains, and you have whatever your net position is with long-term. And then you can start netting them against each other. If, for instance, you had short-term losses, a short-term loss position overall, you could then take that against long-term. But you can't. You have to, keep the same character first and offset, and then you can do your net loss to get to whatever if you're in a loss position, that 3K net loss that you can take. All right. So the long-term capital gain do take into account your ordinary income. So what that means is, like, when you're doing your ordinary income rates, that is without regards to long-term capital gain. So let's say you had 10K of income and you had 10K of short-term capital gains. All of that would be taxed at your ordinary rates. Now, let's say you have long-term capital gains, and I made this example. So if someone has 20K of income from their job and they made 20K of capital gain, long-term capital gains, they would pay 0 tax on that 20K of long-term capital gains, and they pay 20K of ordinary tax. The reason is, so if you see below, I have the tax brackets for capital gains, and it says, if you're single, it's up to $40,400, and this is actually the 2021 numbers. You get 0%, but your ordinary income starts to fill up the bucket first. Okay, that's what I mean by your ordinary income is taken into account. So in my example, that's why, even though this long-term capital gains bracket is $40,400 total, the first 20K is taken up by ordinary income. And then you're able to fill up the rest of this bracket with your capital gains and pay 0 on it. Now, let's say in my example, you had 30K of long-term capital gains. You'd pay 20K at 0%, so 0 capital gains tax. And then the remaining 10%, you'd pay at 15%. And if you would like to see this visually, I know I mentioned smart asset calculators before. I actually like another calculator for this that I think does a really good job of visually illustrating this. So actually, let me just go to it. So this one is on NerdWallet. And so, like I said, so if you had a security that you got and you put in 5K, you got you a couple contracts, you sold it after a year and a half, and it was worth 25K, and you made 20K, and this was your income, excluding your capital gain. So your total income is the 50K, because that's the 20K capital gain plus the 30K ordinary. You held it for more than 1 year, so that's long term. You would owe capital gains tax of $1,500, and that's because you had 10K left in the 40K bucket, right? Because you made 30K. You had 10K left, so that 10K was taxed at 0%. And then the rest of the 10K that you made was taxed at the 15%, and just keep going on up from there. So that's how it works. So you could be somewhat strategic about this too. For instance, I actually did put it on the slide. So, and I think I mentioned this earlier, but let's say you were unemployed this year, but you did have long-term capital gains and you didn't have any income. Well, that's 0 for ordinary. So you can literally fill up this whole bracket and have no taxable gains on 40K. Or let's say you were retired, but you were still trading and you were still making sure that you had your 1 year plus 1 day of holdings. 40K of those of trading proceeds are not going to be taxed. And then the highest you're paying is 20%. Any questions on that? Okay. So I think one question was kind of how can you take advantage of losses, or when kind of to think about, utilizing losses strategically. So there's this concept called tax loss harvesting, and actually I'm going to start at the bottom. So you can take losses whenever you want. Okay. If you have a bad position and it is not for you and it's, on the struggle bus, you can cut it anytime. And if you have other gains, you're going to be able to use it against the gains. Now, where you could be more strategic about the losses is if you have a position that took a loss, and let's say your thesis on this position is right, that it's gonna, run up and go to the moon. It has a, it had a pullback, and maybe there was a reason for the pullback, but fundamentally you still believe in the position. But it's in a loss right now. And let's say it's in December and, you're thinking about, the end of the year and the gains that you've made. You could, and this is the concept of tax loss harvesting, sell those securities to free up the loss that you have, and then repurchase those same securities later because you still believe in it, your thesis is still solid, just for being able to take the losses and have it to use against other capital gains and then ordinary income up to 3K. Now, the IRS isn't slow, so of course they have rules for this. Totally can do it, but when you do it, you cannot buy the security back within 30 days before or after you do this. So if I wanted to tax loss harvest and I sold off a losing position on December 31st, I would have to wait 30 days before I could buy it back in order to truly take the loss. Otherwise, the IRS basically pretends like you never sold it, and they adjust your cost basis back to the original cost basis. So this can be a good strategy, again, if you think your position is a good one. If you think in the next 30 days it's not going to fully recover, because it would definitely suck if you took the loss and then you're buying it back, higher than your original cost basis, because you waited the 30 days and it recovered. Or there could be some strategy in that too, because maybe you just have a significant amount of capital gains that you really want to use the loss against. So that's not necessarily bad, but again, there's a lot of strategy involved in this, and making sure that you're not messing up. This whole concept is called the wash sale rules. They basically call it a wash if you break the 30-day before or after of buying the same security. So you can do tax loss harvesting. You can always just cut your losses and take it against capital gains. But the tax loss harvesting piece of it is just being more strategic about it, freeing up that decrease in fair market value that you've sustained in the short term, so you can use it against other gains. Any questions on that?
Not really a question, but I definitely had to learn about that wash sale through experience. I thought I was slick and trying to
it's easy to think.
But IRS is non-player. They're gonna jump.
No, you didn't sell that. They will come get you quick. Like, nope. And I will go, just to add, for someone who hasn't tried this before, you don't lose if you do, buy it back within 30 days. You see that the price is going up, and you don't, want to get back in higher than your original cost basis. You can, break the rule, and all that means is that, like I said, they'll adjust you back to what you originally paid. And so the loss that you had, it doesn't go away. So let's say ultimately it still ends up being a loss. Whatever year you actually sell it, you'll be able to take the loss that year. So it's not like you kind of get completely screwed over of the loss that you had baked in there. If you do break the wash sale rules. Okay, I'm going to go over this really quickly. I think for most people, you probably aren't going to get tax trader status, because especially if you're following the script and you're, more so doing leaps and in longer positions, you'll have it'll be hard for you to meet these qualifications, because to be a tax trader as a business, you have to be operating in the short term, which I think is the biggest piece. So your short term holding periods average 30 days. That's swing trading, day trading timelines. And again, if you're buying far out, 3 years out options contracts, you're not going to be hitting the thresholds you need to get this status. So you can see on the slide, these aren't hard and fast, but generally speaking, the IRS wants to see that this is for real business. So typically you would want to hit 60 trades a month, at least trading at least 4 days a week. The 60 trades, so a trade is considered like the actual, the buy and the sell be considered 2 trades. So you don't have to do a round trip trade to make that count as one. That would be 2 trades. You couldn't be like, okay, I'm going to stop trading for 3 months because I'm good right now, and then still maintain the status. You have to, be consistently trading. And then the biggest piece with, we've been spending so much time in this conversation talking about, getting money into accounts that grow tax-free. If you're, trading as a business for tax trader status, you can't do that in taxable accounts. Like anything you do in taxable accounts, in tax sheltered accounts, anything you do in tax sheltered accounts doesn't count towards these requirements. It has to be done in a taxable account. So I think for the majority of people, you're not going to be trying to get this. One other kind of key piece to it is a lot of day traders trade on margin because a lot of day traders aren't trading in options. A lot of them are trading in stock, and stock settlement time is longer. The good thing is if you do mostly options, the settlement period is less. So you could potentially, trade out of a cash account and be a day trader, because usually that's settling overnight. But if you were day trading with, say stocks, you probably are going to want to do it on margin. And if you are on a margin account, you have to have at least 25K in that account. And then if, let's say you do want to pursue this, you could either just get tax trader status, which would let you, you'd still be beholden to the rules with capital gains. But there's
one of the things that I really like. It was kind of interesting seeing Black men in tech, and it's like the only thing that kind of struck me.
Oops. I feel like that was Mark voice.
Yeah, I just muted them.
Okay. So, the tax trader status basically gets you the ability to kind of do, the business deductions. So, you have a computer you're trading off of, you can deduct that, you can deduct expenses against that, but you're still beholden to the capital gains rule. So you'd have the 3K net loss that you can take, unless you do a Section 475 election, which gives you mark-to-market accounting, which basically treats all your positions as being sold at the end of the year, every year. So this lets you get around the wash sale rules. But it also makes your trading income ordinary income, which could be a good thing if you, you're deducting a lot of expenses against that. If you have significant losses, that at that point you would be able to use against other ordinary income. But again, I think for most people, the goal is not to have a whole bunch of losses to need to use against ordinary income. That's goal A. But secondly, just it's very hard to meet this part to even get to the mark-to-market accounting election. So, again, I think for most people, you likely, unless you're, day trading, in addition to kind of your long-term, you probably are not going to be able to pursue this. I will say this though, if you do this, any long-term investing is separate from this. So you could still invest long-term, do long, further out option contracts, and have it treated as capital gains treatment with all of this, in addition with your short period items, if you wanted to do both. So they're not mutually exclusive. Any questions? Okay, moving on, because I feel like the last couple slides are the good stuff. Now, how many people have heard of the net investment income tax? Okay, I'm gonna guess not likely many. So this is another tax, and the IRS is always trying to get us. This is another tax that is applicable to net investment income. So your capital gains, your interest, your dividend, even rental income are all considered net investment income. And you get this extra tax if you have, if you're above these thresholds with the combination of any regular income plus their net investment income. If it's above these amounts, you get this 3.8% tax on top of it. Now, you might be thinking, okay, I don't meet these thresholds. But the way this new math works, it's very possible that, very soon you could have enough that that could put you over these thresholds, and then you'd have this 3.8% tax. Now, this would be, again, if you have some of your investments in taxable accounts, you're sheltered from this being included in your income if it's in a tax sheltered account. But it's not far off for many people on the phone to, if you, in addition to your regular income, have some earnings that are in a taxable account and being over this threshold. Like, this is a year, 2 year, 3 year out for, many people on this phone. So it's just something to know that it's there. Just as an example, let's say you had $250K total income, and of that income, $75K of it was net investment income. You get taxed on the portion of your income that is above the threshold. So in this case, you had 175 of regular income. 25K of this net investment income is under the threshold of the single person. So that wouldn't be subject to this extra tax, but the 50K over and above would be subject to the 3.8. So the good thing is that, like, this whole 250K is not subject to this. It's just, anything above the threshold, and that's net investment income. So that's just, again, something to know that's out there, start to plan for when that day comes. Okay, so I know we kind of started talking about this kind of earlier on and thinking about, like, how do I get money in all these accounts, when, where, how. So when I was kind of going down my budgeting journey and figuring out what I was going to put money in and how I was going to do it, I think this, you don't have to do it exactly this way, but I think this is kind of a good place to start thinking about it and considering, like, how you're going to fund, all your accounts. We always want to get money that's free money. So starting off with kind of the 401k match, that's kind of the minimum you want to get into that account, because you want the free money that your employer is giving you. And then a lot of things we don't talk about per se, but for many of us is in the picture is debt. And we want money to trade with. So you kind of have to be strategic about all of this. But that high interest debt is, the debt that's going to be accumulating faster. So, after you get your match, it's a good idea to start, trying to get some of that down, like as far as ordering goes. I have an HSA. I know everyone doesn't have one. HSA is amazing tax vehicle because you get to do contributions tax-free, and you get to take the contributions out tax-free. Now it's supposed to be for medical expenses. That's what it's for. But the way that I use the HSA is, you have a high deductible plan with it, and I did the math on my medical plans. So before I got the HSA, every pay period you have that, insurance money coming out. And I did the math and I was like, okay, the deductible is higher, but then the amount that I'm paying for the insurance is lower. And I did the math on it, and it was pretty much exactly the same for me at my employer. It may not always work this way, but at my employer, it was literally the same amount that I'd be paying when I took into account that I had a higher deductible, but then would have lower payments to the plan. But then I also got the HSA. So for me, once I kind of discovered the beauty of, like, the tax benefits of the HSA, I started to use it. And of course, I don't have any major medical issues, you know, that has to also be, you know, taken into consideration. But the beauty of it is you don't actually have to use it for medical expenses today if you don't want. So if I had to go to the doctor, I could pay out of pocket. I could keep the receipt. In the future, that receipt can go against my HSA for me to take out money later that's been growing and accumulating, even before you get to the age that you're allowed to take it out. So, I mean, the HSA, you can only put 3550 in it as an individual, and then the family's double. But even with that small amount, like, it went in tax-free, so you got tax benefit now. And like I said, it comes out tax-free. So it's like the best of a regular IRA and a Roth IRA. And then once you get to retirement age, you can take that money out, whether it's for medical expenses or not. So if you get money in there and it grows and grows, honestly, if my HSA is high enough, I'd probably live out for that. Then the rest of your 401k, as we were talking about earlier, and then your Roth IRA, and then they have this little like other possibilities, and a lot of this we talked about. So like the mega backdoor Roth, a cash balance plan is basically a pension plan. Like if your company has a pension plan, usually you don't have to do anything to get it. Like I had a pension and I didn't have to do anything, just work. I didn't contribute or anything to it. These are like high income people can defer their comp so they don't have to pay tax on it now. That's a strategy. Usually, you know, C-suite level people have things like that. And then you'll put in your taxable accounts and then, you know, handle low interest debt. So again, you don't have to literally do it this way, but as you start to think about kind of how you're planning out where you're putting your money, this is kind of a way you can think about it, and kind of being efficient about it. And then irrespective of like trading, this is kind of what you can think about. Like if you did have other holdings, and I know a lot of people are kind of mostly options trading. Before I kind of discovered options, I did have some, you know, ETFs and some bond funds. And so I can leave this for reference, but it's mostly just saying like, where do you traditionally put assets so that you're getting the most tax benefit out of it? So for instance, bonds are not tax efficient because you get interest off of them. So having them in a tax-free accumulation account like a 401k is good, because when you're getting that interest, you're not paying today on that interest, and that interest can also grow and be reinvested. Versus you'd want tax exempt bonds in a taxable account because it's already tax exempt. Like why would you waste space in a 401k or somewhere else when it's already tax exempt? Of course, put it in your taxable account. So this is kind of a traditional way to think of asset allocation if you had, you know, all of these types of investments. However, I started thinking about what can I do with options, because, you know, a significant portion of my portfolio is going to be options. And so definitely, like, you know, we throw out, you know, the term leverage plays, and typically, at least from what I've seen, a lot of these plays are shorter term. You're probably not holding them for a year. You're waiting on some type of catalyst. And I think for me, I'm trying to prioritize plays like that in my tax sheltered account. So, you know, the play that we don't talk about anymore, the XOY play, I put that in my Roth. Because I wanted to make sure that, you know, if that's a 5x, 5x, 10x play, and the fact that, you know, I'm probably getting rid of it sometime in, you know, next year, I wouldn't have held it for a year. I don't want to owe tax on this play that has, you know, a 10x return. So I put in my tax sheltered account. Then longer term positions, of course, you're going to want to put as much as you can in tax sheltered accounts. You could prioritize longer term positions to your brokerage, your regular individual accounts, because then at least you'll have the favorable capital gains rates for those plays. And you won't have to pay, those ordinary income tax rates. At most, depending on how much you made, you'd have to pay 20%. So like I have my regular IRAs, I have my Roth IRAs, and I have my brokerage. Within that ecosystem, I'm really trying to make sure I'm thinking about where I'm buying things, and filling out those accounts. I've started to, fill up where things that I'm pretty sure I'm not going to have to pivot out of before the year holding period. Of course, can't tell the future, but just things you feel very solid about that you're going to be able to see to the end of your trading plan and be able to hold it for that 1 year. I'm prioritizing those in my brokerage so that at least, I have the capital gains tax treatment for them. Another consideration I started thinking about is, what are my expected returns? If I have 2 plays that I would otherwise have in a taxable individual brokerage account, but I think one is going to the moon, I may try to prioritize it in a tax sheltered account and, have more of that gain sheltered in that account. And then I just wanted to kind of have a discussion, and I'll give my thoughts on this, but, Roth seems to be king, and that's fine. But with all of these accounts, money's going in, but for a lot of us, money is not coming out anytime soon. So I'll just use myself as an example. I'm 35. My goal is, and I'm speaking it into existence in front of all of you, is to retire before 40. Okay, that's in 5 years. So if I'm putting all my money in the tax sheltered accounts, what money am I actually going to live off of? Because I don't want to take the money out of those accounts and pay penalties on them. That completely defeats the purpose. So, if you're at the stage where you quite literally only have $6,000 to invest, or less, I would consider, maxing out your tax-free accounts is priority, but I think that some should be saved for a taxable account, because you need to grow money in that account so that you have something to live off of when you hit that walk away date. If we do this correctly, none of us should really have to mess with these tax sheltered accounts, and they can go tax sheltered to our to the next generation. The goal is generational wealth. We want more money than we could ever spend ourselves, so that our kids and our kids will have this money. So, it's very, very possible to avoid even needing to take anything out of your Roth. You don't have to take anything out in your lifetime. You don't have to. With an IRA, you do have to start taking required minimum distributions, but again, you can be strategic about it. And so, I want everyone on this call, if we've talked about a lot of things, but I just want you to start to think about that, and thinking about like how you're actually going to live when you do this walk away. Where's your income coming from? Obviously, you'll probably still trade, but again, that would need to be in a brokerage account, a regular individual brokerage account, so that you could actually take the money. So we can talk about that. I'll just kind of wrap up, and then we can kind of talk about it, and then if anyone else has any questions. So I just want to say in general, like, we've talked about a lot of things, and a lot of what we talked about can reduce your taxes. I just want to generally say that at a certain point, focusing on taxes outside of, the long-term capital gain treatment, benefit, and then, making sure that you're taking all the deductions that you're legally able to take, there starts to be a point of diminishing returns to focusing on taxes. Like, I think for me, I was able to, I think it's beneficial to focus on increasing income and decreasing expenses. And those two things will probably mean you pay more tax, but you're going to have more money overall, actually. So I think it's important to understand the tax implications, do some tax planning, but don't fret over it. Don't stress over it. Like, if you have, limited time, focus on the things that are going to, increase you overall. One quick thing though about tax planning, just as an example, when they changed the law and took away like the personal exemption and then the standard deduction as two separate things, it made that big deduction, the 12K. A lot of people weren't able to itemize anymore. So you can be strategic about your taxes. Let's say you give to charity every year, and let's say you give 10K every year to charity. Based off, what you make, and it's usually 10K. Well, if you take that 10K every year, you don't really use it because you have the standard deduction, which is 12K. You kind of don't have it. But if you're strategic about it and said, hey, I have the cash, maybe I will, give 2 years worth of my contribution, so 20K in 1 year. And then the next year, I won't do anything. So let's say you give your contribution throughout the year, and then on the end of the year, you give the contribution for next year up front, but you do it all in 1 year. That way, you have 20K that you now have spent, the same 20K you were going to spend anyway, but now, because now you're over the 12K threshold for itemizing. And now you have 8,000K of extra deductions in that year, and you save money on that. So ultimately, in that scenario, you save money versus doing the 10K in 2 different years. Things like that you can think through and plan for, and be strategic about. But beyond that, I think focus on the money. Focus on the increase part. And then the last comment, like I said, CPAs do a lot of different things. Some don't know anything about tax at all. And that is not a bad thing. They're good at what they do. I have a lot of good friends that are forensic accountants, and they kill it. They will find some fraud in your, financial statements. But make sure that if you are looking for a CPA, that they do what you need them to do. So like if you're a small business and you have, rental, real estate and things like that, like just make sure that the person, is adept at, individual taxes and, some of the nuances that you do. Because even within that specialization, like for instance, when I was working and doing like corporate income taxes, I only worked on financial institutions. So I know the business of financial institutions versus someone who may only work on, consumer discretionary companies. So they know the intricate, things for there. So that's just one word of caution I would give as you're looking for a CPA. If you're looking for one, just make sure that they know about what you need them to know about. And that's it. And yeah, so if you have any thoughts about kind of like if you've thought at all, how you're gonna live during retirement, it's a lot closer than a lot of us probably ever dreamed of. I think now is the time to start planning for that. Anyone have any questions or thoughts or comments about anything from today?
This was phenomenal. You definitely gave me some game with the HSA account. We have one of those, but I had no idea that you could use it for anything other than medical expenses. This was dope. I do, but
yeah.
yes. Go ahead.
Oh, I was just gonna say, yeah, it's beautiful because once you have it, you can spend your own money for those expenses and save. It's like a bank for future reference. So you literally can withdraw without penalty later on an expense you spent 5 years ago.
Yeah.
And save up those expenses if you're, not having significant medical bills on a year-to-year basis.
Yeah, that was a real gem. Shifting gears just a little bit, I have a question with regards to purchasing real estate, either primary or an investment, using the IRA account. It was recently just brought to my attention that you can even do that. But my pushback is, how advantageous would that be for a person, considering that when you purchase real estate and you say you wanted to, buy and flip, you can take advantage of the 1031 tax exchange.
Mm-hmm.
What benefit do you get from purchasing real estate inside an IRA account? It doesn't even make sense to do it.
Yeah, and I'm not really that familiar with that actually, so I can take that back and look into it a little bit more. But at the surface level, I don't that because I guess you could potentially avoid the capital gains on real estate, but that's an interesting one. I'm not that adept at that, so I'll take that back.
That was my thought, because the cap gains, that's what the 1031 exchange is for.
Right.
So I'm like, what's the point? Okay. All right, cool. Anybody else? Do you all have any questions? Anything you need clarity over? Anything you want to add to the discussion before we go ahead and sign off?
I have a question regarding the HSA.
Mm-hmm.
Can you be more specific? So when can you have access to the monies in the HSA to utilize outside of the whatever the medical purposes, or getting the vision or the dental?
Yeah, it's just like all the rest of these accounts. When you get to close to retirement age, 59 and a half. But like I said, the trick to that is if you have qualified expenses that you would have otherwise been able to use the HSA for at the time you had the expense, that's a way to get around that and be able to take the money out earlier. So let's say, I don't know, you spent $1,000 on going to the doctor. That $1,000 receipt, as long as you already have the HSA in place before you spend that $1,000, you can save that, like essentially bank that $1,000 and take it out later at any time past when you pay for that service from your medical provider. So over years, if you're accumulating medical expenses that you did not use the HSA for, you have that bank of expenses that you can pull out of your HSA without penalty prior to the retirement age.
Thank you.
Mm-hmm.
How you doing? I just want to tell you did a great job. I appreciate your presentation. That question you posed, so what do you do when you reach that amount and you have to wait until you're like 59 or whatever age that is, and you're only like 40? Mm-hmm. So like, are you also like I guess trading in your individual account, brokerage account as well? Are you also doing that as well at this point?
Yeah, I am. I have gotten my kind of expense to income ratio down. Right now it's actually at 90-10. It's situational, but so by the time that I've gone through all the tax sheltered accounts, there's still money left over to put into my individual account. But I was partly posing that question because not everyone is in that situation. And so I think people should give some thought to if it makes sense to, take a little bit to put in an individual brokerage and have that trading alongside. Again, prioritizing long-term in that so that you're not getting slammed with short-term, gains in that account. You will have to pay tax when you exit out of an option, because option contract is a finite period of time. So at some point you're gonna have to pay tax on some of your gains in your taxable. But ensuring that they're long-term preserves that those gains that you can keep trading in. And that would be what I tap into first when I retire early, because all these other accounts have all these stipulations for being able to get the money out. 40 is a long time from 59 and a half. That's 20 years.
Facts.
That is 20 years that you need to be able to live when you walk away. Now, there's a lot that goes into this. If you have most of your money tied up in taxable accounts, maybe that's when you start trading and living off, whatever. You still may be trading. I guess Mark could have retired a long time ago, right? He still trades. So it's not like you have to stop trading. You can still trade, but I just think there should be something there that you can reasonably live off of for an extended period of time before needing to tap into that. And just as one other side caution thing, when I started on my journey of like really honing in on my budget and stuff, it came from being a part of the FIRE community, which, if you haven't heard, that's Financial Independence Retire Early. A lot of people in that community don't look like us, but there's some tenets of it that make sense. And part of it is how to get to your money when you have already retired early and it's locked up in these accounts. Like I alluded to it a little bit before with kind of being strategic with, your what's the word? Conversions. So let's say you're in year one of retirement, or really you should start doing it before you retire. But let's say you're in year one of retirement, you have about 5 years runway in your taxable accounts that you can live off of. Well, in thinking about that, you're not working for anybody, and let's say you don't have any side hustles and you legit are not working, you can start taking from your IRAs, because at this point, if you stopped working, maybe you had a large 401k that you now have in an IRA, and you can start converting it piece by piece into your Roth so that then becomes a contribution that's tax-free. And you are subject to that 5-year lockup, so you have to think strategically about when to start doing that. But if you don't have any other income, you can literally take out $50K and only pay 12% on a part of that. A lot of it's zero. You got a 12K deduction today that you can take. So 12K is nothing. Then you're getting taxed on about 10K of it at a 10% rate, and the rest of that 12% rate, which is more favorable than, when you probably worked. So you could free up 50K without even going outside of the 12% tax bracket, put that in a Roth and start having money there accumulating to then be able to take out as a contribution, because at the 5-year mark, that has effectively become a contribution. And as you know, contributions can be taken out anytime.
Thank you so much.
Mm-hmm.
And big ups to you for that 90-10. That's what's up.
Thanks. It is a little situational. I have to move for my job soon, so I'll probably be closer to 75-25, 70-30. But yeah, it's amazing, like how much money we have at our disposal that we don't realize once we start to focus and be intentional about it.
Facts. All right. Does anybody else have any other questions before we sign off?
I don't have any questions, but I want to make sure, do you do this I joined this late, so you may have shared this information, but is this a business for you that you're doing, or how do we connect with you if we have questions or?
Sure. No. I usually do a couple people in my family's tax return, my tax return, but open. I have out of this community, larger TBD Gym will come up cousins community. So, simple questions. I don't have any problem answering. I may take that back later, but
okay.
Yeah, I was about to say that's simple questions. I don't know.
Yeah. I didn't mean to put you on the spot. I'm sorry.
No worries. Like,
okay.
Yeah, it honestly is something I thought about like later as my second career. Like when I retired, I would love to like spend more time helping people like set up their life, like and think through all of these things. It's just not something I'm currently doing.
Okay. Thank you. I appreciate you.
No problem.
Hey, Sean, we might need to override that restriction, throw her in the chat, but we'll talk about that offline, fam.
About the conversion, did you just say that you do it after you don't have any more income, or can that be done if from a traditional rollover IRA?
Yeah, you can do it anytime. So so the conversions are anytime thing. The rollovers, like if you're going from like one plan, so for instance, your 401k rolling over into an IRA, that has to be with some event. So like you change jobs, so you're able to do that, right? But the conversions you can do. And that's why it is, you should give some thought and around like how you could take advantage of doing it to make sure that you have enough funds like when you do retire early that are available to you, that aren't locked up.
So going with say I was going to retire in 5 years like you, and I have an IRA that I have already rolled over from an old job. If I do that now, am I limited to how much I can roll over, or do I just need to be able to pay whatever taxes I have?
Yeah, you're not limited to what you can like convert to a Roth. I would though suggest thinking about kind of, what taxes you're going to have, because if the reason I wouldn't do it now is because doing it now would mean I'm paying higher taxes on that than say in my example before, I waited to the first year of retirement and I started doing it then where I have no income and I'm in the 10% and 12% tax bracket.
Oh, gotcha.
Yeah. So, for me, the way that I've approached it is I need enough in my taxable accounts that I can live off of for at least 5 years and maybe a little bit more. Because again, that money, that conversion is locked up for 5 years each time you do it. So every year you do it, that first set, 5 years. The second set, it has its own 5 years. Third set has its own. So it's kind of laddering it. So if I have enough capital to sustain myself, and then obviously I'll probably still be trading. So between the capital I already have going into walking away, granted that pile may be, small compared to my overall portfolio, but like we just said, that money's locked up. I want to make sure I have enough to sustain me in the short term until I can start trying to, free up additional capital. And then also, maybe bringing in some from, still trading in that account. Because you have to also think too, like anything can happen in the market, right? So maybe the year you retire, there's a huge dip in the stock market. There's this concept sequence of return risk. Like you may have a $1 million portfolio, but if that portfolio goes down significantly in the first year that you retire, that actually may not sustain you through the rest of your life. So if you have some padding there and you have some money that you'd be able to live off of while your portfolio recovers, then, you know, that's another risk that you're mitigating, that, you know, you walk away and then you have to walk back. We don't want to walk back. We want to be free forever.
Gotcha.
So that's just some things to think about.
So it's better to do the conversions when you have little to no income. Got it. Thank you.
Mhm.
All right. Anybody else got any questions or comments? If not, we're going to go ahead and sign off. Just make sure you're following us on all social media platforms. TBD, Tom, B as in Bravo, D as in Delta, Gen Wealth on Facebook, Instagram, and YouTube. Yeah, this was amazing. Phenomenal presentation. We definitely appreciate you taking the time out to give us this free game. And y'all already know how we rock. We give value, no fluff. So that's just what we're doing. Any other closing remarks, Kristle?
No, thank you for letting me do this. I enjoyed talking with you guys today, and happy to be part of the community.
All right, there it is. All right, y'all. Thanks for coming out. See you next time.